The inflation of money printing. The easy money policies of central banks have led to an increase in the amount of money printed. The article explains which central bank decided to do this, and how they are trying to reduce their impact on inflation. Inflation in the USA. Inflation is a technical term used to describe an increase in the price of goods and services in an economy. The main cause of inflation is an increase in the supply of money and credit, which makes prices rise faster than the rate of economic growth. The Federal Reserve has been printing money at an unprecedented pace since 2007, which has caused prices to rise faster than wages and salaries. Inflation is now running at 2.9% and is expected to keep rising until 2025. This has had a significant impact on the lives of American citizens, as their wages have not kept up with the increased cost of living. In addition, inflation can have a negative impact on the economy as it reduces consumer spending, which can lead to a recession. The inflation of money printing. The Fed prints money like there's no tomorrow, and the result is skyrocketing prices. What's going on? The Federal Reserve has been printing money like crazy in an effort to stimulate the economy. The theory behind this is that more money in circulation will lead to increased spending, which will create jobs and help the economy recover. However, what the Fed hasn't taken into account is that people are now able to purchase more goods and services with the new money than they could before. This leads to inflation, or a rise in the prices of goods and services. So far, the Fed's monetary policies have had mixed results. On one hand, they've helped keep interest rates low, which has encouraged people to borrow money and buy assets such as stocks. On the other hand, the number of jobs available has not increased as much as hoped and inflation is running high. In fact, some economists believe that we could be headed for a full-blown economic recession because of all the money printing by the Fed. Some critics of the Fed's policies have been very critical even though the overall economy is growing and unemployment is at a 60-year low. They say that there has been a lot of money printing by the Fed and it shows in rising inflation rates. The Federal Reserve's main duty is to fight inflation like the Fed does. But before we start getting worried about ever higher prices, we should also remember that our wages have not increased much in years and interest rates are at historic lows. So when you hear pundits complaining about rising prices, they might not know what they're talking about. Central banks and interest rates. Inflation of money printing has been a persistent problem in the world economy for many years. Inflation is defined as an increase of the general price level in an economy over a period of time. This phenomenon is generally caused by an increase in the amount of money supply, which results in a decline in the value of money. When central banks print too much money, it causes an increase in prices throughout the economy because it dilutes the currency, making it more difficult for people to purchase goods and services. This inflationary environment can quickly spiral out of control as businesses and consumers become increasingly reluctant to spend their money, thus exacerbating the situation. It is important for policymakers to understand the dangers associated with inflationary environments in order to make sound decisions about how much money to print and when. If left unchecked, this type of inflation can lead to widespread economic instability and even global recession. The impact on the other countries. The National Bank of Ukraine has announced that it will print 1 trillion hryvnia, $27.5 billion, in the next year to finance government spending. The announcement comes as the country battles an economic crisis in which inflation has risen to more than 50%. Printing money has long been a practice used by countries to combat economic downturns, but the National Bank of Ukraine's decision has raised questions about its impact on the rest of the world. Inflation is already high in many other countries, and printing more money could drive up prices even further. Prices for goods and services are often fixed according to international agreements, so an increase in inflation can have a significant impact on people's lives. Some economists believe that printing more money will only make the economic crisis worse in Ukraine. Others say that it's important for the government to take any steps necessary to stabilize the economy. Either way, the decision raises questions about the role of money printing in today's economy. The recent increase in the amount of money printing by the Federal Reserve has caused significant inflation in the United States. The implications for other countries are twofold. First, the higher prices experienced around the world are a direct result of the Federal Reserve's actions. Second, this inflationary environment makes it more difficult for economic growth to take hold, which could have serious consequences for global economies. The recent increase in printing of money by the Federal Reserve has caused a sharp rise in prices across the nation. The inflation of money printing can be seen in almost every sector of the economy, with goods and services becoming more expensive for everyone. This is especially true for those who cannot afford to pay higher prices, such as low-income individuals and families. The inflation of money printing has also had a significant impact on the other countries around the world. Many of these countries have been struggling with high levels of inflation for years, and the sudden increase in money printing has made it even worse. Inflation is a major problem because it makes it difficult for people to afford basic necessities like food and shelter. It also destroys valuable assets, such as homes and savings. The IMF has warned that the inflation of money printing is creating a global economic crisis that could get much worse before it gets better. If not addressed quickly, this crisis could lead to a worldwide recession and increased unemployment rates. Why do central banks raise interest rates? Central banks have long been known for their ability to print money, which they do in order to stimulate the economy. However, this act of printing money has a cost, namely, interest rates. Inflation is another name for price inflation, and it's when prices go up faster than the rate of inflation. When central banks raise interest rates, it makes it more expensive for people to borrow money, and this can stifle economic growth. Central banks around the world have embarked on a policy of raising interest rates in order to slow the inflationary spiral caused by quantitative easing, QE. It is important to understand the root cause of inflation before making any judgments about raising interest rates. The reason central banks are raising interest rates is because they want to reduce the amount of money that is in circulation. When too much money is circulating, it causes inflation. There are a few different ways that money can become inflamed. 1. Printing more currency. When a government prints more currency, it creates an increase in the supply of money and drives up prices. This is what happened during the 2008 financial crisis when the Federal Reserve printed billions of dollars in order to bail out banks. 2. Lending money at high rates. When banks lend money at high rates, they are able to charge higher interest rates on loans than they would if they were lending at lower rates. This leads consumers and businesses to borrow more money, which then fuels inflation. In order to prevent this from happening, central banks typically restrict credit availability by raising interest rates. 3. Purchasing goods and services with inflated currencies. Conclusion. Inflation is a problem that has been plaguing economies for centuries. It starts with the government printing too much money, which drives up the price of goods and services in an effort to keep up with the demand for currency. This causes people to go into debt, because they can't afford to buy what they need with their inflated currency. Eventually, this spiral of debt leads to economic collapse, as people are unable to repay their loans. Thanks for watching. See you on the next episode.